You might remember that during the pandemic, used car prices absolutely spiked. And to be clear, we are not quite at that level, but used car prices are starting to creep back up over the last few months. Used car prices jumped to the highest level since 2023 as auto tariffs squeeze consumers. Tariffs prompted a rise in used car prices in April, which rose to their highest level since October of 2023. And that frankly really sucks because cars for basically everyone are not optional. And when used car prices spike, this creates difficulty for people that need them, especially people of lower incomes who can't afford to buy new cars and instead have to buy only used cars. And when those used cars get more expensive, either the amount of money they have to pay gets more or their monthly payments increase. This creates kind of a poverty spiral where they're unable to get themselves out of their own situation because prices are going up faster than they can earn money. And I think this is also frustrating for people because this outcome was predicted by basically every economist ever when Trump announced auto tariffs. We all knew that this was going to happen, and even cars that are made in America have pieces that are manufactured overseas, and because of the tariffs, those pieces are now more expensive, leading the cars to become more expensive. Used car buyers are getting hit by higher prices for used cars as the auto market adjusts to President Donald Trump's 25% tariffs on auto imports. Used car prices in April were notably higher than in March, as the Manheim Used Vehicle Index rose to 208.2, which amounts to a 2.7% increase from March and is 4.9% higher than last year. That's a huge jump. That's the highest reading for the index since October of 2023. And we can see the index here. This is where we are now, and to be clear, it is nowhere near what we saw during the pandemic, but this small spike right here is what we're seeing, and that's what's really concerning. This is the biggest jump that we've seen in over a year, and even though it's not as bad as it was during the pandemic, people shouldn't panic, but people should start to be wary about where this could lead, because we absolutely do not want another one of these massive increases where the price of used cars essentially doubled. CNBC talks more about this here. It also marked a 2.7% increase from March. That's a significant rise compared with a historically typical month-to-month index move of about 0.2%, according to auto data and logistics firm. The spring bounce normally ends in the second week of April, but this year, wholesale appreciation trends continued for the entire month and were much stronger than we typically observed, said Jeremy Robb, Cox Automotive Senior Director of Economic and Industry Insights. We expected to see strong price appreciation in response to tariffs, and that is exactly what came. So he's basically saying that when the tariffs were announced, people expected that the price of used cars would go up because the demand went up. And that's basically exactly what we're seeing. Now, to be clear, the price tariffs only apply to new cars that are imported or pieces for new cars that are imported. It's not a tariff on used cars. But if the price of a new car goes up by, say, 25%, then a lot more people will decide, oh, a new car is too expensive because it's 25% more expensive than it was previously, so they'll go and buy a used car. What this does is this means a lot of customers that would have bought new cars are now buying used cars. So the demand for used cars absolutely skyrockets, which means the price of those used cars is going to go up as well. Cox reports retail used car vehicle sales in April were down by 1.7% compared with March, but higher year over year by 13%. Over the last 4 weeks, the average retail listing price for a used vehicle increased by 2% to more than $25,000, Cox said. That compares with new vehicles starting at nearly $48,000, which is kind of crazy. The Manheim Index remains off record highs that hit during the COVID pandemic, but is still relatively high compared with historic levels before the onset of the global health crisis in 2020. Cox previously said that it was seeing used vehicles prices continue to stabilize after swinging wildly for several years before starting to calm down in 2024. So what he's saying here is that the sales are down, but the prices are up. And if you're curious why both sales would be down and prices would be up at the same time, Fox talks about it here. Used retail sales remain stronger than normal, and wholesale days supply is a bit tighter, so we'll likely be seeing less depreciation than normal over Q2. As we move into the second half of the year, though, the auto market may slow down as strong demand likely pulled some of the transactions forward in March and April as buyers tried to get ahead of expected higher prices due to tariffs, Rob added. So what we have here is the second big factor that's affecting car prices. The first was tariffs, and then the second is people freaking out about the tariffs. Basically, people are worried that the tariffs are going to increase prices, which is something they should be worried about. They absolutely will. And because of that, they're, instead of waiting a few months to buy a car, they're going ahead and they're buying the used cars now. And that spike in demand caused by people buying cars now instead of waiting a few months or spreading out their purchase is leading car prices to skyrocket. Now, there is also a possibility of greedflation here. I don't have any articles or anything to back this up. I haven't really looked into it as much, but basically this is where a company will charge more because people expect to pay more. And then the company will blame tariffs or supply chain issues or something like that. This happened a lot during COVID, where companies were reporting absolutely record profits profits while saying that the reason that everything was so expensive is because the supply chain was bad, which was true at one point, but then companies were very reluctant to lower their prices because people continued to buy whatever it was they were selling at the much higher prices. Before we go on, if you like this kind of deep dive into financial topics, I post 1 or 2 times a week, and I'd love a subscription. So we've got these auto tariffs impacting customers because the price is increasing, making it more difficult for people to buy cars affordably or forcing them to take on higher monthly payments for cars. However, tariffs don't just hit customers, they hit companies as well. And so the question is, well, how are companies doing in light of all of this? And the answer is not great. Toyota sees $1.3 billion profit hit from Trump tariffs in 2 months. Toyota expects profits to decline by 1/5 in the current fiscal year. And that's a lot of money. Toyota is a Japanese car company, but they do have a lot of auto plants in the United States. And a profit loss in the United States means layoffs in the United States, which means job losses in the United States. And this is personal to me because I lived near the Georgetown, Kentucky Toyota plant, which is an absolutely massive plant, the largest actually outside of Japan, employing some 10,000 people. Basically, the entirety of the local economy is structured around that plant. So I have friends or a lot of friends' parents that work at that plant. You can imagine if Toyota is suddenly unable to manufacture and import parts to be assembled at this plant, employing American citizens, that a lot of those people would lose their jobs, which would have an impact both on Japan's economy because they're not exporting parts, but also the United States' economy because the people that the parts are imported for, which is the workers at the plants, so that they can assemble them and build cars in the United States, are losing their jobs. The article goes on. Toyota executives predict Donald Trump's automotive tariffs will cost the company $1.3 billion in April and May earnings. The automaker, which reported its highest ever annual profit last year, according to the New York Times, expects profit to decline by roughly 20% in the current fiscal year, it said on Thursday. The world's top-selling car manufacturer said it expected operating income to total 3.8 trillion yen, which is $26 billion, in the year in March 2026, versus 4.8 trillion yen, $33 billion, in the year that just ended. Whether these tariffs are permanent or not, what will happen is not something we can decide, CEO Kanji Shadow said during a media briefing. Now, I frankly don't have any sympathy for big companies, but what I do have sympathy for is the employees of those big companies. And because of how sudden and frankly haphazard these tariffs are, those employees won't have a chance to slowly transition their careers to another plant or another manufacturing factory or some other opportunity. It's happening hard, it's happening fast, and American citizens that work for these companies are not being given a chance to adapt and change careers. And it's not just Toyota, it's also domestic companies as well, or companies that we think of as being American. Ford, billions in profits will be wiped out by tariffs. Ford Motor Co., already facing significant headwinds in 2025, said it will lose billions this year if Trump tariffs are allowed to proceed. Other automakers face the same plight. But it's not just those two. General Motors is also struggling. GM projects to lose up to $5 billion hit on profits because of the automotive tariffs. And these two are American companies. American made means absolutely nothing if nobody is around who can afford to buy things that are made in America. Now, in the past, when I've discussed this issue, I've always heard people say, well, of course. I mean, this is intentional. The point is to force these auto companies to bring jobs back to America. And frankly, I'm not opposed to jobs coming back to the United States. But with that specific statement, there are two very big issues. The first is that we simply don't have the manufacturing plants available to build these cars. We shipped all of the car manufacturing overseas to China, and then we got rid of the plants or repurposed them or sold them or demolished them. We don't have plants in the United States that can go build cars from start to finish. The Financial Times talks about this. Reshoring has been a top priority for the US president, referring to Donald Trump, with companies such as Apple, Diego, Johnson & Johnson rushing to announce $1.9 trillion of investments in the United States since his election, including bolstering their manufacturing capacity. But the property search, design, and construction of a factory, along with permanent applications and ordering robots and other manufacturing equipment, will mean that plants take years to complete, and many are unlikely to be finished before Trump's second term expires. It will take between 3 and 10 years in most cases to build new manufacturing facilities in the United States, said Aaron, an economist in the conference board who has a design and construction background. Everything takes time before you can get a picture of a congressman with a shovel in their hand, she added. And this is the big issue. It will take basically the entirety of Trump's presidency to complete these manufacturing plants. And then let's say the next president reverses these tariffs. Well, then all of these automotive companies have spent billions or tens of billions of dollars on a bunch of plants that they're now not going to use. That's just lost money. And this means that companies are not sure if they should even build the plants. They have a couple of bad options. They might, one, start building the plants that they might not need if the next US president gets rid of the tariffs, or two, they just take the financial hit now in hopes that the next president decides to get rid of the tariffs. And I think you can see how that's a lose-lose situation. Now, I said there were two big issues of the we're bringing manufacturing back to the United States argument. The second one is that labor just tends to cost a lot more in the United States. America has a higher minimum wage and a higher cost of living than China, for example. And as such, paying American workers costs way more than it does to pay Chinese workers. Lower costs almost all attribute to cheaper labor in China, where all in, employee costs are about $15,000 to $20,000 per annum, which means every year, versus $80,000 to $100,000 per year in the West, that's the United States. And manufacturing costs are likely 50 to 60% lower as well in China versus the United States. If it costs 4 times as much to complete a construction of a car in the United States, then the company, in order to not lose money, will have to charge 4 times as much as they currently do in order to keep the same profit margins that they have. We saw earlier that the average new car was about $48,000. Well, if they have to charge 4 times as much, then that puts the average new car at like, what is that, $192,000? I don't know about you, but that's a little more than I'm willing to spend on a new car. And frankly, I'm not actually even that opposed to tariffs forcing domestic manufacturing, especially for really important things like computer chips or weapons. My issue is that it's being done so haphazardly and also being done in one big fell swoop where companies are given between like 30 and 90 days to figure this out, when it's a process that should take probably 2 to 10 years for them to be able to adapt to. If it was slowly implemented over a reasonable timeline, that gives consumers and companies, say, 2 to 4 years to figure things out and get ready for whatever that entails. If that is what was happening, then I think there would be a much more legitimate argument for it. But as it stands, I really think this is just going to hurt people. Thanks for watching.